Wondering what's next after the corona crisis? Here are a few scenarios and action items. Hi, my name is Christian Wurzelball. I support the textile service industry with management training now in Textile Service 4.0 and practical hints that you can implement right away. Yeah, I've spent the last few days to study not just financial data of textile service companies, but also financial data of the market environment. And I've also read a book about deflation. So I'm not a financial consultant, I'm not a financial expert. I have some knowledge in finance, so I used to be one of the best students in the MBA, and I try to educate myself in this realm, but I'm not an expert. So, but I try to make sense of the current situation, and I think this video is very important. And at the end of this video, you get also very valuable action points. So stay tuned. So the question is, what happens next? Do we have a recovery, a V-shaped recovery, as you call it? Will we have inflation or hyperinflation or stagflation, however you call it? Or do we have even a real crisis and a deflation? So I will share with you some thoughts about this. So on the one hand, why should there be a normal recovery? So a V-shaped recovery looks like this. We used to have some growth, then we had COVID-19, and then it looks like this probably somehow. So we could have this type of recovery, and there is also a reason why we should have such a recovery. So in the past, there used to be SARS and other impacts, and they had a very strong impact in the short term. But at the end of the year, it was almost as it didn't happen. So many health crises didn't have a lasting impact. And there's also quite some reason why COVID-19 shouldn't have some lasting impact. So, and also when you look at China, China is basically on a growth path again. So there is quite some reason that this can be true. But there are also two scenarios that are concerning, and that you have to evaluate, and that you have also to prepare for, because there is also quite some quite some likelihood that this could materialize. So one thing is, okay, this is the European Central Bank, but the Fed is even worse. So it's basically all over the world the same. That in the case of Europe, you had a balance sheet of the central bank that was 11% of the GDP in the beginning, and then so this was 11%, and then we have here now, right now, 62%. So there is quite some growth in the amount of in the money in circulation. So I'll refer these sources in the description of this video, and you will get also inflationary pressure, because in the last years the money of the central bank was just used to buy up government debt, but right now the government spending, so the financial deficit, is also entering the real economy, because the money is distributed via helicopter into the whole economy. So basically, you have quite some reason to get inflation in the next time to come, and therefore inflation is a scenario. And there is also quite some new debt, both from the government, from corporations, and also from households, so private citizens. And I don't know what the Canadians did. So either they didn't have much debt to begin with, but they increased debt by 80%. But even the United States increased debt within 1 year by 50%. So this is huge. Europe, it's still 25%, which is also huge. There is much more debt, both on the level of the government, corporations, and private citizens, and therefore we have actually a debt crisis. You see it also in the debt of America. So this is Congressional Budget Office, an official document, and the projection is that we have quite an issue there. So Europe is probably very similar, but America is even worse. So we are heading to quite between 100 and 160% of GDP in debt. And at this point of time, you are starting to get real issues. So the issue is, on the one hand, that you have a devaluation of currencies. So maybe you do not see the consumer prices rising domestically, but you get much inflation from imports. So this is an issue. And there is also quite some risk of hyperinflation, so 10, 20, 30% per year, because the Fed is not able to raise interest unless you bankrupt the state. So you have either a bankrupt state, or you have high inflation. So it's actually no good choice at all. So when inflation starts, they might not be able to raise interest rates, because otherwise, on the one hand, they crush the markets and could really burst the bubble and crash the economy completely. And on the other hand, the state will not be able to pay these interests. So this is actually a really big thing. And when you compare also, when you look at the Treasury bond and the Standard & Poor's, so this is 81 and this is 98. So this is 98 here. So unfortunately the charts are not the same, but they end at the same point of time. So basically what you see is that the interest rates are used to be between 7 and 10%, and right now the interest rates is even negative, or at least 0%. And at the same time, you had really a rally in the equities and also in real estate and so on. But this rally was not fueled by a very good economy, but actually by low interest rates. So you have the issue that these low interest rates have fueled these stock prices, these real estate prices, and once you have to increase the interest rates because there is not enough trust in the currency, because there's so much debt that you need to raise your interest rates in order to refinance debt, then all of a sudden you reverse the trend, and the stock prices, the real estate prices go down quite a lot. So you could have say minus 50%, minus 90% drop in stock prices, in real estate prices, depending on the industry, on the region, and so on. And so central banks have caused the bubble. So we have actually a bubble, and I think that's not really disputed. And the question is only whether we have how long will it take until the bubble explodes, and then they have actually no ability to decrease interest rates even further. So basically they have started since 2008 with quantitative easing, and the balance sheet has increased quite a lot. And of course, if you raise interest rates again, then you burst the bubble. So that's the point. So the third scenario is deflation, and so this is quite an issue. And the point is that technology is deflationary. So when you look at productivity increases, you get a huge productivity increase when you have a different technology. So for instance, AI, artificial intelligence, will replace even physicians. And in some cases, computers can make much better diagnosis right now. And I'm sure that in 5, 10, or at least in 15 years, you will be able to replace almost every physician with a computer, and he will do a much better job. And then you can decide whether you want to have a much more expensive diagnosis that is worse than a diagnosis from a computer that is better and cheaper. So there will be, in many industries, in many professions, a complete change. For instance, accountants. Who needs an accountant when you have an automatized way to make your bookkeeping with AI? You will need much less truck drivers and taxi drivers, because you have cars that drive themselves, and so on and so on. So there are many industries that will completely change, and this is an increase in productivity, and this increase in productivity will reduce costs, and reduced costs reduces prices. So there is a real big pressure in price decreases because of technology. And the point is that computing power is increasing about every 18th month. So it doubles every 18th month. So next, in 3 years' time, we'll have 4 times stronger computing power in the world, and in 5.5 years it's 8 times, and in 6 years we have 16 times more computing power than currently. So this means that there will be a real change in possibilities and changes in the industry, and this will help to increase productivity, which is good. It will give us many benefits, which is good, but it will destroy also many jobs, and therefore it will change industries. It will increase unemployment, in the meantime until you change over the workforce, and you will get a deflationary trend just because of technology. And of course, you have also the issue, as I already mentioned, with a bubble. So when you when you burst the bubble, then you trigger a deflation. And there are Kondratiev cycles, which is very interesting. So there are long curves in the economy that are driven by technology. So on the one hand, you had the steam engine, you had railway, and then you had chemistry, automotive, and then information technology, and the next is then AI and other technologies. So these are disruptive technology that change the way we do business. And in this case, many companies go bankrupt because the business model doesn't work anymore and something new has to arise. And in this phase between these cycles, we had always also depressions. And the point is, we should have had this depression in the last 20 years, but we didn't have it because of the central banks that inflated the money and the currencies. So we have most probably an issue there in the next 5 to 10 years, and COVID-19 is just a facilitator of even faster change, because people have started now to be accustomed to video conferences. They do not travel a lot, so you have much more learning in the internet and so on. So COVID-19 has driven change, and we'll see whether the world and the economy after COVID-19 is still the same as before. And therefore we have to prepare. We don't have to prepare for the first scenario where we have a V-shaped recovery and then we just need to have some champagne and celebrate and go from there. But there are two scenarios where we have to prepare for. The one is inflation, where money becomes worth less. The value of debt decreases. Gold is actually a safe haven in this case. And the point is, if you have long-term contracts with the customers, then you need to be careful that you have no fixed prices. And maybe you should have even the possibility to increase prices during the year. So if you have, if you are only able to increase prices once a year, then this can be already an issue there. And then the real issue, of course, is deflation, where the value of money increases and the value of debt increases, or at least it stays the same. And the collateral, the securities that you give the bank, decrease a lot. So this is a really real issue, and you have to think about it. So it doesn't necessarily have to be an issue with your company, but when your neighbor, who is a retailer or is a hotel that is empty, and it drives down real estate, then the value of your own real estate is reduced, and the bank has to adjust the collateral. So, for instance, if your real estate used to be, say for instance, a value of $1 million, and your real estate is valued then at $500,000 for the bank, then the bank needs to reduce its balance with you for $500,000. And this means that they will not be able to grant you debt. They will need to reduce credit facilities and so on and so on. So this is really not a good situation. And of course, you have also the issue with recession and depression, where you could have also empty hotels and quite some reduction in travel, because everything that is not necessary for your life will not be spent. So savings goes up. So both corporations and private households do not spend money, even if they have one, and you get a real recession and depression. So what's important in this case, to have the right customers, to see which customers are resilient in a depression, and that you reduce debt, because debt in this case is very bad. And of course, if you have cash, then cash is king, because for instance, if you have $1 million in cash around, then you will probably buy as much as you would. You wouldn't need to spend 10 million or 5 million to get the same for 1 million in this case. So cash is king, no debt, and to have the right customers. So these are the three scenarios. And on the one hand, you have the V-shaped recovery, where we had the COVID-19 crisis, which went down, and then maybe we overshoot and it goes up. So this is the first scenario, and we hope for it. Then we have the second scenario, that inflation picks up. So this is the second one. And then at some point of time, so either for instance here, or even in the near future, you could have basically a depression, so a deflation, which when the bubble bursts, for instance here. So I think you have to prepare for the long term, because you need to prepare, for instance, for a deflation now, because when it happens, then it's too late. So you need to prepare yourself right after this crisis. So unfortunately, after the crisis is before the crisis, most probably. It's actually a tough outlook. So it doesn't necessarily have to be the case, but I think it's good to be prepared. Therefore, it's important that you think through the deflation and inflationary scenarios, that you check your contracts, and that you strengthen your cash flow, and that you reduce debt. So I hope this video was helpful. I'm sorry to give no good news in this case. I think the good news is that COVID-19 will be over very soon. But the bad news is that we will have to prepare for the next crisis. But the good news there is that those who are prepared will cope with it much, much better. So I wish you the best. I wish you much strength and much success. And I will also make videos how you can improve your cash flow, how you can improve your operations. So subscribe to my email list. I'm sending out emails once or twice a week, which are very valuable. And if you're an entrepreneur, you can also book a strategy session with myself, and we'll have half an hour conversation, and we'll take it from there. So, of course, subscribe to the channel and like this video, and we'll see you as next time. Bye-bye.